This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney, where the market has just opened. The top stories this hour. Asian stocks are set for a subdued open. Traders sifting through mixed earnings reports ahead of US jobs numbers. Amazon sliding after the bell on a weak profit outlook. US Treasury Secretary Scott Bessent defends President Trump's tariff plan, telling Bloomberg that China's economy is the most unbalanced in the history of the world. Plus, the Bank of Korea governor says a rate cut this month is not a done deal, telling us exclusively that more fiscal stimulus is needed.
Yeah, we'll be watching the Korean won when markets trading starts. Of course, we have seen significant pressure already for the South Korean currency at a time when the Japanese yen continues to strengthen. Take a look at that, 151 against the US dollar. And this, of course, coming at a time when we're really watching the Bank of Japan for more tightening from here. A board member now saying that they could see hiking rates to 1% by March of next year. Nikkei futures not doing much right now. We do have the RBI rate decision today. They're expected to start their easing cycle. Take a look at what's happening on the other side of Asian currencies, the U.S. dollar and U.S. assets, because we heard also from the Treasury Secretary that the U.S. continues to have a strong dollar policy. Take a look at how futures are trading, because we're seeing a little bit of downside pressure. I mean, we had seen a mixed finish for benchmarks in the U.S. trading session, mixed earnings results, not to mention that this is coming ahead of jobs data. Of course, that is expected to be a bit messy, given that it will also factor in the impact of the California wildfires. We already had initial jobless claims, a little bit of a dip or a little bit of a rise, but still sort of subdued. We had labor productivity coming in solid. We're watching Amazon in the after-hour session really under pressure after their profit guidance fell short of expectations. Haidi.
Well, U.S. Treasury Secretary Scott Bessent says he will refrain from criticizing the head of the U.S. Central Bank and that the Trump administration is not fixated on lower interest rates. Bessent told us that he's already had a constructive meeting with the Fed Chair, Jay Powell.
We did. I did an away game over at the Fed. We had a very nice breakfast. Chair Powell and I don't know each other well, so it was very constructive. Everything I'm going to talk about is things Fed done in the past. Prospectively, monetary policy, I will not comment on, and I'm sure he's going to do the right thing, so there'll be no criticism.
Let's bring in our political news director, Jody Schneider. And Jody, this is sort of really notable because it's perhaps one of the maybe rare instances where the campaign rhetoric has not translated to what we're now hearing in the early days of the administration, right? We had so much criticism, even kind of threatening by President Trump to fire Jay Powell, but it seems like that has been walked back.
Yeah, it certainly does seem that way. And among the interesting things that came up from the Treasury Secretary's interview with Bloomberg Television earlier today, he basically said he wasn't going to criticize Jay Powell and that right now they are not going to push them on rates. A little different than the president himself when the rates were not changed 2 weeks ago, basically came out and said the Fed was too into DEI and they spent too much time on that and they should focus more on things like cutting rates. But the Treasury Secretary, very measured, really stepped away from sort of any sort of involvement of the White House in the doings of the Fed. He said they're going to sit back and let them do their job. He said the same thing about the Internal Revenue Service, which has been a target of President Trump in the past. He said through tax season, they have a lot to do. We're not focusing there.
What do we know right now about, of course, the GOP tensions that we're seeing because of Elon Musk's attempts here in order to downsize the government, essentially?
Yeah, so today was supposed to be a deadline, late today in the U.S. It was supposed to be a deadline for federal workers who had received notification of a possible buyout. The deal was that they would be able to be paid through September, but they would give up their jobs, and they could give them up right away, or perhaps face the threat of losing their jobs without that deal in the future. So far, about 40,000 50,000 or more, probably between 40 and 50,000 federal workers signed up for that. That's only about 1% or so of the federal workforce, and a lot of them maybe were going to retire anyways. But today, before that deadline was able to take effect, a federal judge said this he is freezing this at least for a while until they can look at the legality of doing this, whether this program actually meets the legal standards. So for right now, it looks like the deal is on hold. Those who took it will be remaining, at least for now, and others won't be able to sign up for it.
And sort of super interesting were his comments on China, right? Take a listen.
I think especially that China now, given all their excess capacity, will, no matter the level of the tariffs, will end up eating quite a bit.
What would we hear, given that, of course, this particular sort of tariff point has been subject to so much confusion and to and fro and concern from financial markets?
Yeah, so Scott Bessent has said to have not been wanting as high of tariffs, perhaps, as President Trump. And again, he sort of downplayed the effect of them while saying that no matter how high they are, China will eat them. He seemed to be saying that, first of all, he doesn't expect this to roil markets terribly, but at the same time that there will likely be tariff action and perhaps more tariff action against China in the future. We didn't get any specifics there, but he did nod toward that in terms of the tariffs. Of course, China, the U.S. imposed 10% tariffs on some Chinese goods this week, while stepping back, at least for now, on imposing threatened 25% tariffs on Mexico and Canada.
Bloomberg's political news director Jody Schneider there in Washington. Let's take a look at how markets have been reacting. Let's bring up Bloomberg MLive strategist Mark Cranfield. Mark, it has been an exhausting week for traders, no matter what sort of asset class you're looking at the moment. What did we see in terms of the reaction to what Scott Bessent had to say? And of course, there's also a lot of sort of, treading water on the sidelines ahead of the US jobs numbers.
A lot of what Bessent has to say is not really relevant to bond traders on a day-to-day basis. They're much more interested in what he did with the quarterly refunding this week, which was largely to keep the long-end funding pretty similar to what it has been and to suggest that the funding situation there will remain stable for at least the rest of this year. That's pretty good news if you're an investor in long-term Treasury bonds. And you can see the curve has been flattening over the past few days, and it's continuing to do so. So that's what fixed income traders really care about, is the issuance coming out of the US government, especially considering that before the Treasury Bessent actually took his seat, people were concerned there would actually be a big increase in bond sales and that it may be skewed towards longer term debt. That doesn't appear to be the case. But of course, some of the policies look as though they could be inflationary in the short term. And really now it's all a question of looking back to the key data that we get. It starts with the jobs data today. We expect the unemployment rate to stay around 4.1%, which is still pretty strong. Doesn't give the Fed much leeway to lower interest rates on that basis. But even more importantly, next week there's a CPI number. It looks as though the core data will again come in above 3%, which all of the Fed speakers have been suggesting for now that a pause is fully justified. And if we get data which shows that the jobs market is strong and inflation is pretty sticky, it certainly feeds into the fact that short-term yields can't come down very much. And if anything, the curve can flatten a little bit further.
Mark, Scott Bessent also talking about maintaining the strong dollar policy under the Trump administration. It's not like they have a choice, right? I mean, we have seen all of these other central banks cut rates. The Bank of England, for example, just cut rates, and we have pressure on sterling.
You've got, as you say, I mean, interest rate differentials play a key part in this. The US is still running with relatively high interest rates compared to, particularly against the G10 space. So there's very few people that can compete with the US dollar, whether it's the pound, the euro, Canadian dollar, even the Japanese yen. Short-term interest rates are way below the US, and that obviously gives the US dollar an advantage. The other part of the equation is also this story about US exceptionalism. We've seen the US equity market especially has been a fantastic performer for the past couple of years, better than most other major markets in the world. Now, this is the point at which global investors at some stage will question this. They will question whether there is justification for the US equities to have such a premium over the rest of the world. And when that story begins to change, that will be reflected in a weaker US dollar as well. Also, the question of whether foreign holders of things like Treasury bonds will continue to have faith in the quality of the US Treasury as well. Those are questions for further down the road. But clearly, the idea that US exceptionalism can continue indefinitely is something that investors are already considering. And when they decide in large numbers that it's no longer the case, then the US dollar will be the safety valve and it will decline.
And life strategist Mark Cranfield there with the latest. As we continue to watch all of this central bank action, it's the RBI's turn to decide on rates later today. New central bank governor Sanjay Malhotra is expected to cut rates by at least 25 basis points in his first policy meeting to boost growth. We also spoke exclusively with Bank of Korea Governor Rhee Chang-yong about the central bank's rate path. Of course, there's been a lot of speculation of a rate cut later this month.
We are definitely also interest rate reduction cycle. So when and how much, we will look at the all other elements. But definitely we think that monetary policy and fiscal policy both have a room to have a more accommodative monetary policies.
Coming up in the Asia trade, Wilson Asset Management will be along with us to dive into Aussie earnings season. Pendal Group also joining us in the next hour to give us their fixed income strategy. We'll also be talking all about Japanese Prime Minister's trip to the US with the Japan Institute of International Affairs. That and much more ahead. This is Bloomberg.
Amazon shares under pressure in late trade after we got a weaker than expected outlook in its latest results. The e-commerce giant is still spending heavily on AI. Let's bring in our tech reporter Annabelle Drulers for more. Belle, so what stood out in the numbers?
Yeah, well, I think it was pretty much as you said there, Shery, coming down to that guidance in particular for the first quarter, because the company kind of undershot expectations here. And what's sort of interesting is the dynamic that played into that. And it's actually very much a currency story as well. So revenue guidance for the first quarter, net sales are expected to be between $151 and $155.5 billion. There is sort of a currency impact, as I said, that plays into this, but it's somewhere to the tune of around $2.1 billion in the quarter. So again, it's going to be having it ramifications. We saw that as well in the fourth quarter, dollar strength that came through and played into the figures. But generally, the company as well, aside from sort of undershooting expectations there, they did commit to continuing that investment into AI in particular. AI, we're referring, of course, to the cloud business, and saying that essentially the vast majority of the $100 billion for capex that's slotted or slated for 2025 is going to be spent on these services. DeepSeek as well, I was just reading through the earnings call, it did come up as well, and AWS is essentially saying that their vision of the future is when you're going to have a lot of different generative AI apps using multiple model types, different customers as well. They're going to be using different models. So trying to kind of shrug off some of the concerns around DeepSeek. But clearly, I mean, it's come up in every single tech call rather this week.
There were some bright spots, though. What were they?
Yeah, that's right. We saw, of course, really what was led by in the earnings call from the CEO there, Andy Jassy, but essentially talking about the figures that we had in the fourth quarter. So that was reporting a revenue of around $188 billion that they were pointing out, of course. That's a gain of around 10% year over year. They did, of course, nod to the FX ramifications or the costs that they incurred during that period, because they saw $700 million of more FX headwinds than they'd anticipated in their guidance. So that did play into the results. And if they hadn't had those, they were saying that revenue would have increased 11% year over year and exceeded the top end of guidance. But generally, other segments as well that they were optimistic about comes back more to the e-commerce side of the business, saying that they'd managed to grow in North America, other markets as well. Speed of delivery continued to accelerate. They added more prime customers as well. Overall, delivering 9 billion units the same or next day around the world, and also other things like streaming services, for instance. They're continuing to add more offerings into that. But the focus of the results very much today on that first quarter guidance and undershooting expectations from analysts.
Our tech reporter Annabelle Jewell is there. Let's take a look at how Australian assets are trading just about 18 minutes into the start of the staggered open. We're seeing a pretty muted session Friday so far. We're expecting that sort of muted mood to continue as we get into, of course, US jobs coming a little bit later on today. We're seeing some of the losers being led by energy with that dip in crude prices again overnight. Some of the leadership, though, coming from real estate and materials names. Some of the miners still seeing gains early in this part of the session. The Aussie dollar largely unmoved at this point, despite some of the comments when it comes to a stronger US dollar from Scott Bessent in our Bloomberg interview overnight. And also taking a look at one significant mover that we're seeing, Domino's Pizza Enterprises gaining 18% so far in the session, flagging some pretty significant store closures to be expected. 205 unprofitable stores, most of them are in Japan, where it has 944 outlets, and pretty much 1 in 5 of those Japanese stores will be closed, with sort of an acknowledgement of those losses coming from perhaps overreach and COVID-era expansion there. So that's one company that we're watching. But of course, broadly here in Australia, earnings season is starting to get underway. Investors focused on potential rate cuts from the RBA and these ongoing trade war jitters. Let's get more from Anna Milne, who's a senior investment analyst at Wilson Asset Management. Anna, really great to have you with us. And it is unavoidable, despite, of course, a lot of idiosyncratic stories within the Australian market. What do you see as being the broad impact of geopolitical elements and the sort of, I guess, proxy effect of the trade war?
I'd say firstly, when thinking about key global themes, momentum still reigns supreme. And what we're really looking for this reporting season is those names that have seen significant value expansion, whether we will actually see the earnings coming through. Examples of that are the likes of the banks. We won't get a fulsome earnings report, but we'll have the likes of the CBA, which we'll watch closely, as well as consumer discretionary, tech, and some of the market beta names. On the trade war, as you say, we expect discussions with China will be complex and more ongoing than what we've seen resolutions from the likes of Canada and Mexico. From an Australia perspective, we are watching the miners. We think Trump is a deal maker and a deal will be made, and then sentiment can really shift back to looking at potential stimulus in March. We expect stimulus could be announced in March at the MPC meeting once they know what they're dealing with from a tariff perspective. So we are still quite positive on BHP and Rio into that.
So you think the risks are still kind of broadly to the upside when it comes to some of the China economy proxies here?
I'd say certainly there is a significant buffer because sentiment is so bad in these names still. I'd say long term there are certainly structural issues. There is no denying that. But tactically positioning wise, we are positioned for a bounce in those names.
What about the consumer?
Indicators suggest that the Australian economy is doing okay based on retail sales, government spending, building approvals and the like, but it does feel like it is baked into market forecasts for earnings growth for companies over the next 12 months. In addition, with forecasts being broadly accurate, we also have elevated valuations. So the setup really for the consumer stocks, I would say, is a little bit tricky from here. And expectations for the stocks themselves, the likes of JB Hi-Fi and Wesfarmers, are very high. Anecdotally, November and December were very strong trading periods, but we'll just have to see what happens next week as to whether they can beat elevated expectations.
We touched on financials earlier. Do you think if and when the RBA finally does move, does that meaningfully change the outlook, the profit outlook for the Big Four?
We don't believe this changes the profit outlook for the Big Four if there is a rate cut, but it is important to realise that the rally that the banks have seen hasn't been fundamental, so any changes in the fundamental environment probably aren't going to be what changes the sentiment for the banks. Really, when thinking about the direction for banks over the medium term, it's a matter of fire and ice of the ASX 20. It's the miners versus the banks. The miners have been so out of favour, we think that should they see somewhat of a recovery, this might see pressure on the banks.
What do you see sort of, Australian stocks have for a very long time been almost a source of safety. We've seen, of course, a record year last year. But I think from an international holder's perspective, they often seem sort of quite boring and domestically focused. Do you see that view changing? Is it something that you would see as more as part of a global portfolio, given a lot of the other risks that we're seeing around the world?
Definitely. I think Australia is viewed quite idiosyncratic to the rest of the world. I'd say that the strength in earnings in the US has certainly outpaced Australia, but when appetite for China is so low, Australia is not a bad proxy if you're wanting some exposure to maybe a really out of favour trend, such as China, through a safer means with the Australian market.
Tell us about some of the more compelling names that you're watching specifically.
We like the insurers. They have done well over the last couple of months, but we see support from both an earnings and a valuation side to come, particularly IAG and QBE. Both of them are below their weather and cat allowances. Premium rates are softening, but they are holding, and claims is really reducing. So we like insurance. We also like infrastructure. I would say, given the bond yield complex we're seeing over the last month, they've been kind of unloved and unnoticed, and compared to the likes of tech. So in our universe, that is Transurban and that is Atlas Arteria. We think their traffic update recently was actually quite good. Expectations are relatively low. They are sturdy, they are safe stocks in Australia at the moment.
The other domestic risk is obviously the upcoming election. Once we find out the timing, what are you looking for in terms of the potential upside or downside risk to particular sectors, depending on what policies we could see announced?
A very interesting sector in that regard, I would say, is healthcare. It does feel like the private hospitals and the health insurers are at a stalemate, but it's a question of what can the government actually do about it, and are they willing to step in, and where will the funding come from? I would say more broadly on the healthcare sector, we are quite negative. I think Ramsay is probably set up for a difficult update. CSL actually in the large cap space as well. We are a little bit concerned into this result. It feels like the more recent data points, such as Haemonetics overnight, is looking quite soft. And it doesn't feel like the bearing division, which has previously been the absolute shining star of CSL, is firing quite as much as investors are currently thinking it is.
Anna, really great to have you with us. Anna Milne, who's a senior investment analyst at Wilson Asset Management. As we head into, of course, the thick of Aussie earnings season, we do have more ahead on the edge of trade. This is Bloomberg.
Take a look at how currencies are trading at the moment. We have seen the Japanese yen set for the strongest week since November. It's right now the most traded currency against the US dollar, holding at that 151 level against the greenback, as the offshore yuan is also sitting a touch below 730. This is Bloomberg. We're getting breaking news out of Japan. Household spending year on year rising 2.7% for the month of December, really beating expectations by a lot. The expectation was for a gain of 0.5%. It's also coming back from 4 months of contraction. This despite the fact that we continue to see inflation here in Japan potentially hurting consumer pockets. But we have seen the biggest wage growth since 1997, and even real wages growing now for a second consecutive month in December, and household spending surprising to the upside, growing 2.7% for the month of December. Here in Japan, we're also watching Prime Minister Shigeru Ishiba's trip to Washington, D.C. He's expected to proceed cautiously in his first meeting with President Donald Trump on Friday. He's looking to avoid tariffs and reaffirm his nation's security alliance with the U.S. Bloomberg News senior editor Brian Fowler joins us now with the latest. And Brian, of course, we know that Mr. Ishiba is relatively an inexperienced premier. The bar is set pretty high, given that Trump had such a good relationship with Shinzo Abe.
Yeah, that's absolutely true. I think Shinzo Abe is actually casting a shadow over this visit for Ishiba. Trump had a genuine fondness for Abe, and that was largely due to the way Abe handled that relationship. He kept Trump smiling. He lost at golf. and they really connected well. Abe's widow visited Mar-a-Lago just 2 months ago, so that relationship kind of continues, and the image I think Trump has is of a very polished Japan. Well, Ishiba is very different. He's a little bit more he's quiet. He's not socially skilled like that. He was raised in the countryside of Tottori, and he kind of retains a little bit of that outsider air about him. So it's a real question whether he'll be able to make a good connection with Trump.
And yet, I guess, given the reports that potentially he could be announcing more investments into the U.S., could he at least try to buy his friendship?
Yeah, there's some good things he can do. I mean, of course, SoftBank made a nice splash last month with the promise of investment, and Ishiba can talk about energy, maybe promise to buy more LNG from the U.S. or shale gas. There's definitely things he can pledge that would win Trump over. Trump, last August, made a comment about Japan. He said Japan's been very tough on the U.S. and continues to be. He hasn't said anything like that since taking office, hasn't talked about the trade surplus or Japan's large share of the auto market. But if it does come up, I guess the big question is, does he then segue into tariffs or something else?
Is the Nippon Steel US Steel deal expected to come up? We know that historically Trump has been opposed to this as well, but we also know that he did meet with the US Steel CEO.
Absolutely, yeah. He met with the U.S. Steel CEO just yesterday in the White House. So I haven't seen an actual readout of what that meeting was about, but it's definitely obviously on Trump's agenda. It could come up. I don't expect Trump to want to try to revive the deal. I mean, he's opposed it just like Biden was, and we don't really know if Ishiba is going to try to push it, but it could definitely be a topic.
Bloomberg News senior editor Brian Fowler here with a preview of that very interesting and high-profile conversation between Trump and Ishiba. Coming up, we'll have more on that meeting as we speak with the Japan Institute of International Affairs. That's happening at 8:30 a.m. Hong Kong time. Bank of Korea Governor Rhee Chang-yong is pushing back against mounting speculation of a rate cut later this month. The BOK is widely expected to resume its easing cycle in February as concerns deepen over slowing economic growth and the impact of Trump's tariff war. Speaking with us exclusively here in Tokyo, he says the central bank's indication of openness to more easing in the next 3 months was conditional and not a commitment.
We are definitely also interest rate reduction cycle. So when and how much, we will look at all other elements. But definitely we think that monetary policy and fiscal policy both have a room to have a more accommodative accommodative policies.
Especially now that you have seen a few weeks of the Trump presidency and all of these tariff threats coming into place.
Right. So that is why I'm emphasizing more fiscal stimulus is necessary. First of all, we in the last 2 years, when we have a very high inflation period, unlike other countries' government, our Ministry of Finance maintained a very conservative fiscal policy.
It seems to be that right now the won is stabilizing at that mid-1400 levels. Is that sort of the new normal now?
I wouldn't say new normal, because if I say new normal, it means that I have a certain level in mind. I think we have to look at what drives our exchange rate. And if I phrase this way, I think in December I was very uncomfortable because our exchange rate is moving a lot, depreciate a lot more than other currencies because of political reason, which is our own unique reason. On the other hand, in January, actually Korean won behaved better than other currencies because this on abnormal regions is subdued, while still, in terms of level itself, the Korean won is also affected together with other currencies by the strong dollar trend.
Why not make a move now when potentially the effects and fallout of all of these different risks from the domestic and external factors could come in at some point later in the year?
Actually, I think this is a criticism that I got a lot in domestically these days. Why you are not cutting interest rate more actively? I think there are many reasons. I think monetary policy and interest rate cannot solve every problem. Okay, and then like if you have a low interest rate, and definitely it will help people to pay back their debt, and it may make a little more stimulus to the economy. But on the other hand, you have to think about negative side impact. One is that it may end up increasing the asset prices, especially real estate prices. It has a direct impact on the exchange rate. And yes, we can manage it, but if it really depends, environment. If the exchange rate is depreciating quite rapidly, you don't want to put the oil in the fire, right?
That signaling when it comes to fiscal policy is so important for also household sentiment, right?
Yeah.
How are they doing at a time when prices are still rising? I mean, inflation right now, the latest one overshot your target, right?
No, but our inflation, we reached our target a lot earlier than any other countries. In the last 2-3 months, our inflation was below 2%, and in December it was like 1.8, 1.9. Now the recent figure went up to 2.2% because of the depreciation of our currency, exacerbated by the higher oil prices. But given that last year, in the beginning of the year, oil price was quite high. So if you think about baseline impact, I think the inflation rate for the next couple of months will probably move down around 2% level.
What about imported inflation? And at that point, I mean, what level of the won would reflect economic fundamentals?
So I think I already mentioned that, last month our exchange rate went to like 1470. So about 71 higher than prior to the martial law declaration. And if it stays there for a whole year, then we will have about, at the time we are projecting 1.9% as an inflation rate. But if one stays around 1470 level for a long time, I think our inflation, I have to at least give 0.15% more to. So it will be like a 2.1, 2.5 something rate. So we won't be like a 3% or something. So, but exchange, if exchange rate further depreciate, that will definitely will cause our inflation rate higher.
Which would then, in turn, make it more challenging to cut rates?
Right. Yeah, sure. But we are not at the stage yet. So currently, as of today, our exchange rate is on about 1450. And depending on the U.S. tariff policies, especially with respect to China, and then also Japan's monetary policy decision down to April and July, there's a room that the exchange rate move in both sides. And at the same time, in our calculation, about 31 is increase of exchange rate was due to this martial law declaration. It's political reason. So there's a room that once our political situation become much more stabilized, the room that portion can go down. So it's very hard to predict which direction the exchange rate will go.
You have experience as the IMF Director of Asia Pacific during the first term of President Trump. Can you get any lessons from how the economy, rates, and FX moved back then because of the trade policies, and do they apply now?
Actually, there was a kind of benchmark that when I think about Trump 2 policies, I thought that my experience will help very much. But now I believe that the second term of Trump administration is quite different from the first term. So I don't want to say.
What's so different?
It's not just a tariff policy. I think it's very hard to, at this moment, I have to look at it more. But this may change a lot of international order. So we'll see how it goes.
Especially those comments around the U.S. taking over Gaza, the Middle East tensions.
I think I won't comment on it. But at this moment, I think what I'm feeling at this moment, it can be much more broader than tariffs.
External shocks coming from the likes of oil prices.
So look, as an economist, and especially trained economist by the IMF and also policymakers in Korea, you do not excuse that why you missed the reason. What reason drive it? You look at the market. When the market changes, you adjust your policy. That's your job.
Yeah, Bank of Korea Governor Rhee Chang-yong speaking exclusively to Bloomberg, really determined to watch the data incoming in order to make that next decision at the end of the month on rate cuts. More ahead on the Asia trade. This is Bloomberg.
With US earnings season in full swing, many investors are looking to company spending plans for clues on sentiment and confidence for the year ahead. Let's bring our senior editor, Nina Trentman, who also writes our CFO Briefing newsletter on the terminal. You can find it at Bloomberg.com too. So, Nina, great to have you. So what are CFOs telling you about the sort of outlook and how tricky it is to make these capex commitments right now?
Yeah, thank you for having me. What I'm hearing from CFOs is very much that here in the US, people are reasonably optimistic coming out of the election. So we're seeing that in surveys, we're seeing it in interviews and conversations that sort of overall there is a lot of optimism about what this new administration will do. And so that is leading people at Bloomberg and elsewhere to sort of expect that capex spending will go up a little bit compared to last year's levels. So for the S&P 500, the expectation is about 1.1 trillion, which is in excess of what we saw last year and also the year before. Of course, that business optimism is driving it, but then also we're seeing other drivers like, for example, artificial intelligence, which is resulting in a lot of spending by large US corporates. Of course, as we will hear in a bit, it is tricky for companies and CFOs to make these decisions because they don't have a crystal ball and they don't necessarily know what's going to happen, especially also as they're navigating the Trump administration that has already sort of started some policy initiatives and then didn't follow through on it. So, of course, that makes life much, much more complicated for CFOs around the world.
Yeah, Nina, actually, let's hear directly from a chief financial officer. Nina, you're sticking around. We want to bring in Tim Arndt. He's a CFO at real estate investment trust Prologis. Tim, good to have you with us. As Nina was just telling us, especially when it comes to trying to understand President Trump's policies, when you're doing business globally and you have invested heavily on, say, nearshoring trends, I know that you have facilities in Mexico and business there. How does that affect your decision right now in where to put more money?
Well, thanks for having me. And, just to step a moment back on Prologis, we are the world's largest owner of logistics and warehouse facilities. We have 1.3 billion square feet around the globe in 20 different countries. And with regard to the question that you're asking here, interestingly, our investment strategy is not really around nearshoring whatsoever. Actually, what we've done is we've built a portfolio that's focused on the consumption centers, the largest consumption markets around the globe, leaving us a bit more agnostic to where goods are ultimately manufactured and produced. And in that regard, we're certainly watching the turbulence of some of these policies, but we expect the demand for our product to remain pretty steady.
A lot of optimism on artificial intelligence and, of course, building out the logistics and the infrastructure for that. But when you have potentially lower cost models coming up, could this be an issue that you're perhaps factoring in now?
Well, as for Prologis, our involvement in AI is principally through some data center development and conversion activity that we've been embarking on. Even though we're historically a warehouse and distribution facility owner and operator, we certainly have it being the case that many of our facilities are suited for higher and better use conversion into data centers. So we've been investing in that. We've built a large team around it. We've been very active over the last 2 years, have a number of projects coming out of the ground right now. But we do it all on a build-to-suit basis, that is securing leases with these largest hyperscalers. And so long as that demand is good, we'll keep up the conversion activity.
Tim, just following up on that, I'm just wondering, can you talk a little bit about the view that you have into your clients' plans? So when you're making these capex decisions, what's the time frame with which you're allocating, given that, of course, many of these build-outs not just take 1 year, but potentially more years than that?
Yeah, that's a good question. I mean, the typical warehouse facility takes maybe a year to construct when you go vertical, but you're actually planning for many years prior to that, preparing the land and getting your entitlements. And we are active in doing a lot of that front-end work today to be ready for demand as it surges. As we look into 2025, we do expect an uptick in demand, or as we call it, net absorption in our markets, really because we're seeing customers use some of the gray space that they had built through COVID, some of that availability. They're finding that they need to expand outside of their current footprints, and we're getting ready for that activity.
Just wondering, actually thinking about other uses of capital. We've talked about this before. I'm wondering how you're thinking about deal making. That's also one thing that people are optimistic when it comes to the Trump administration here in the U.S. I'm wondering what your thoughts are on potential M&A that Prologis could do.
Well, look, we have a track record that reflects we're very interested and happy to engage in M&A activity. We do it where targets can be synergistic to our portfolio and when there's a real value add for our shareholders, and that can be episodic, and of course it's something that we watch all the time. Our principal mode of growth is really through development of new logistics facilities, and that's on the order of $3 to $5 billion per year. And then we also engage in a third-party acquisition form of deployment that may be between another $1 and $2 billion per year. So we're pretty active even without large-scale M&A.
Tim, how much of that activity is happening across Asia and perhaps even here in Japan, given that, of course, we have a very different rate environment than other advanced economies? We're tightening rates and sending them higher instead.
Yeah, you know, it's funny. In logistics, our business, the demand is driven by various different factors. If I think about Japan, for example, as you cite, a big part of our business there has been around developing new facilities, really in the spirit of supply chain reconfiguration, modernizing logistics facilities that were decades old at this point. So that can be activity that we engage in and is value creating, pretty much agnostic to the rate environment, because we're really recycling capital at the end of the day, building assets at one yield and financing them with a cost of capital below that yield.
I'm just thinking about shareholder returns here at this point. Of course, that's also an important focus for our viewers. What are your thoughts on that for this year as we're thinking about 2025?
Well, as I think about the main driver of our growth in 2025 is really going to be renewing rents up to market levels. Something that has been present in logistics real estate for the last several years is there was a very sharp uptick in market rents through COVID. And because logistics leases tend to be 5 or 6 years in length, even though there's been some softness in leasing across the end of 23 and 24, there's still very significant rental rate uptick for Prologis that's still present for us here in 2025. For example, last year in 2024, we renewed the lease rates on our rolling leases by 70%. We won't be quite at that level here in 2025, but there's still going to be meaningful cash flow growth.
Tim Arndt, really good to have you with us, CFO at Prologis, and of course, Bloomberg's Nina Trentman, our senior editor. Bloomberg CFO Briefing is a weekly newsletter with views from global executives and key trends in corporate finance. Subscribers can sign up on Bloomberg.com or also check it out on the terminal. We have more ahead on the Asia trade. This is Bloomberg.
Let's get you the latest from the corporate front. Tokyo Electron is sticking by its annual outlook while outlining plans to build a $681 million plant, suggesting it expects sustained AI spending. It is just one of a handful of global chip gear makers with customers including Samsung and TSMC. It also reported better than expected quarterly earnings, with operating profit jumping 51% from a year ago. Puma says it plans to ship fewer Chinese-made sneakers to the US. It's relying instead on suppliers in Vietnam and Indonesia as the trade war with China heats up. The German company says it's now sourcing only about 10% of its US shoe imports from China. That's down from 30%. Honeywell shares fell as it confirmed it will split into two publicly traded companies following pressure from activist investor Elliott Management. It will separate its aerospace division from its automation business while continuing with earlier plans to spin off its advanced materials unit. Honeywell says the process should be complete by the second half of next year.
Take a look at how we're setting up for the broad market opens. We have seen U.S. stocks finishing a little bit mixed. The ASX 200 at the moment losing 0.2% as Nikkei futures are also trending down. We had seen strength in the Japanese yen, which continues against the U.S. dollar. We are headed now for the strongest week for the Japanese yen since November. The most traded currency versus the greenback right now. Hedge funds heading for the exits on their dollar trades and turning their attention now towards the Japanese currency. currency. Of course, we have heard from the BOJ board member Naoki Tamura also talking about raising rates to about 1% by March of next year. And that's really having markets pricing in about 75% probability of another increase as soon as July. We already had the Japan December household spending numbers surprising to the upside, gaining 2.7% year on year. And this is the first gain in 5 months, despite the fact that we do have inflation accelerating. And this, of course, perhaps not surprising, given that we also saw the biggest wage growth since 1997 and real wage growth finally rising for a second consecutive month in December. All of this as we continue to watch any potential implications from geopolitical tensions. We do have that summit between Shigeru Ishiba and Donald Trump.
Lots to watch out for, Shery. Take a look at commodities at the moment because we are seeing a pretty mixed picture. Crude, first of all, we are starting to see the continued drop for a third week is looking very likely on the back of Donald Trump's tariffs. Some of the push that we've seen in domestic production for energy assets weighing on the broader outlook there as well. We are seeing WTI trading a little bit softer there at the moment in New York and down almost 3% this week. On the upside, we are seeing copper and base metals advancing.
This is the Asia Trade. We're counting down to Asia's major market opens as we head towards that big jobs data in the U.S. Haidi expected to be a bit messy because of the impact of the California wildfires. We also have an RBI rate decision. And we also, of course, had comments from the Treasury Secretary, Scott Bessent.
Messy is a pretty good way to characterise how we've gone through this week, right, in terms of just the turmoil and back and forth that we've seen when it comes to global tariffs, the reactions that we've seen from some of these other countries as well. So there is still that sense, Shery, that investors very much still on edge. Even as you say, we're kind of going back to basics with now firmly watching those jobs numbers amidst a very complicated picture for the Fed.
Very complicated picture for the Fed, also for the Bank of Japan. We are seeing that rise in the Japanese yen against the U.S. dollar as well. We heard from a board member talking about sending that hike to 1% in the rate level here in Japan, at least by March of next year. So we are firmly in the tightening path. And on top of that, of course, these uncertainties globally really leading to that safe haven flow into the Japanese currency, now sitting at that 151 level against the dollar. And you can see right there that we are seeing that downside pressure when it comes to the broader stock markets. We could see the best week for the Japanese yen since November. The 10-year yield also at multi-year high levels. So we'll continue to watch where yields and the yen go from here as earnings is also in focus. Take a look at how the Kospi and the Kosdaq are coming online. We're watching the Korean won, given the commentary from the Bank of Korea governor who spoke to us telling us that a rate cut was not necessarily a done deal for later this month. You can see a little bit of strength against the greenback. The Kospi also under pressure, 0.3%, Haidi.
Take a look, Shery, at what we're seeing in Australia. Pretty muted start to the session as we're just about an hour into trading. We've come off those session lows, at least, just still a little bit of softness, a tenth of 1% there. Energy with that third weekly dip in oil prices expected, leading some of those losses, but we are still seeing some upside when it comes to materials and miners. Copper is the standout, and of course we can see continued more bullish calls when it comes to gold as well, and that's been benefiting some of the gold miners and precious metals miners there. The Aussie dollar is holding pretty steady. We are seeing broadly, though, in terms of sectoral rises. Food chains are actually on the rise with that big gain that we saw of almost 20% for Domino's listed here in Australia. But some of those food retailers are advancing after Domino's said it would close over 200 unprofitable outlets, most of which are based in Japan. Taking a look at bonds, as of course we count down towards the US jobs numbers, Treasury futures trading pretty steady at the moment, and we are seeing a bit of a dip when it comes to Aussie debt at the moment. Let's bring Amy Patrick, who's the head of income strategies at Pendal Group. Amy, great to have you with us. In a lot of ways, it feels like we've sort of lived 4 years in just a few days, right? Just a few weeks of the new administration. How are you navigating this?
Well, I try to think about ultimately how all of these narratives that are currently being spun by the market will ultimately feed into the economic landscape. Because at the end of the day, when you're trading fixed income, the longer term in bond yields, where bond yields go, where policy rates end up going, it's dependent, as long as you believe that central banks ultimately are wanting to control inflation and make sure that growth doesn't fall off a cliff. Ultimately, it's those fundamentals that matter. But you're absolutely right. It's just been, one night it's one narrative that drives, both equity markets and bonds one way, and then the next night, another headline comes out. And the latest thing that I've been thinking about is, the Treasury refunding plan obviously gave US bond yields a sigh of relief. It allowed them to rally a bit a couple of nights ago. But that's a plan. That's got nothing to do with what may come up in the upcoming next couple of weeks. Even tonight's jobs numbers, as you say, in the US could suddenly derail that again. And in the absence of really concrete economic news, I think the market's going to continue to be a bit directionless here.
If you kind of go back to basics, how liquid do you want to be at the moment in any portfolio?
Oh, incredibly liquid, I think. And what I think about the most in this kind of an environment where you don't have that many you don't have a North Star to guide you in terms of your ultimate portfolio direction, that you have to be, as an active investor, able to move your portfolio around, move your positioning around such that you're not caught out and then stuck by bad surprises that, markets or headlines or whatever can give you. So I think in this environment, what I think about the most is how quickly can I move things around in my portfolio, and also how high is the quality of my portfolio. This is not an environment to be going into when you're seeing, for example, leveraged loan default rates starting to go up in the US, that you want to be leaning into the pointier end of credit markets. You want to be leaning into, illiquid private credit types of allocations. This is the time to be dialing back those types of allocations and looking for, safer havens and the ability to move things around.
Amy, but on the other side of that argument, people would say just stay the course. I mean, given that the uncertainty is so high and we have really no clear picture of what the trade tariffs and just basically broader policies coming from the Trump administration will look like. Are there any staples in your portfolio that, despite keeping your nimble moves in other parts, you could just rely on?
Absolutely. So for me, being based in Australia, Australian investment grade credit has over multiple cycles shown that even if you did nothing with it, even if you were quite passive with it, it gives investors a really good risk-adjusted outcome. Now, overall yields and overall spreads aren't, yields are good because the yield environment is higher, but overall spreads are still quite tight. That gives me caution to not go towards the higher beta end of the spectrum, but probably stick towards, the higher quality names, the names that we know and love and have issued over multiple cycles, the blue chip names in Australia. So that's the core part of my portfolio. So when you're talking about staying the course, yes, I love staying the course in that way, but the staying the course in a broader sense of, overall portfolio direction. Do I want to be risk facing? Do I want to be bond facing? I think there is no right or clear course to pick right now and to stay on.
How do you factor in all of the different changes when it comes to currencies? Because it seems when we're trading headlines, that's the first reaction that you see. Even if you're staying put in blue chips, for example, a lot of these companies, especially that operate abroad, could take an impact on their FX side of things.
Absolutely, you're right about that. But I also think on the currency side of things, again, when we're looking at the Australian companies that are issuing investment grade bonds into our market, by the time those currency movements affect their businesses so much that even at the senior debt level, the company is starting to face headwinds. There's a lot of buffers underneath you to be able to absorb that. So I would worry a lot more about that if I were, for example, in the Australian equities market. I'm slightly less concerned about the near-term headwinds from those currency uncertainties on the Australian credit market.
In terms of the opportunities that you might see in Australia, how does sort of the timing and expectations from the RBA sort of work around that?
Yeah, great question. Look, right now, I think I had a look at my desk before I came here. We've got over 3.5 cuts priced in for the RBA until the end of this year. So that's quite a decent uplift since we saw the December quarter inflation numbers come out in Australia earlier in the month. And so, of course, the market's now almost, certainly pricing in a cut from the RBA in February. And, I'm not one to massively want to push against that narrative. I do just wonder, though, however, in terms of the mix of the data and the shape of the economy that you've got in Australia right now seems to tell me that the economy isn't going very, very strong or hot like you're seeing in the US, but it's certainly not falling off a cliff. So for 3.5 cuts to be warranted as the right pricing for the market, or rather to want to bet on the fact that the RBA can cut more than what the market's pricing in right now, to be incredibly bullish on Australian rates, I think you have to be seeing more signs of weakness come through that I simply don't see right now.
How much in terms of signs of weakness are you seeing from China? And is there anything around assets that could potentially be interesting for long-term investors?
So if we stick in the near term, the moment of right now, obviously we're going through the long Lunar New Year period. Chinese consumers are out spending, and the patterns that you're seeing are echoing the patterns that you've seen probably since the COVID pandemic. So to the extent that Chinese consumers are going out and spending, you're seeing a lot more of the spending being spent on domestic travel and tourism. Box office sales in China have gone through the roof this year compared to the prior years, and definitely compared to pre-COVID 2019. A little bit of dining out, etc. as well. In terms of buying of goods, whether it be in store or online, luckily that's up a little bit on the margin, but not really meaningfully high. And ultimately, I think in order to get that consumer spending impulse headed in the right direction, there's just so many fundamental problems that need to be solved first in China. And in the backdrop behind all of this is still the very ailing property sector. So when there's this massive sort of wealth effect drag on the consumer's psyche, it's really difficult to get them to get out there and spend. But I do wonder whether Beijing's thinking about, how many more tit-for-tat moves do they have left on tariffs until eventually they might have to pull out, maybe not a big bazooka, but a medium-sized bazooka in terms of stimulus, and are they putting that in their back pocket, thinking, what's going to come at them next from the Trump administration?
Amy Patrick, head of income strategies at Pendal Group there. And of course, as we continue to watch the market reaction from earnings season here in Japan, Tokyo Electron's third quarter operating income beating expectations, especially when it comes to that outlook for more investments into artificial intelligence. They reaffirmed their annual outlook, and they plan to build a 104 billion yen plant, suggesting that we are continuing to see that sustained AI spending. We also had Nippon Steel's third quarter net income beating expectations, and we've been watching Nippon Steel's trying to take over U.S. Steel that was blocked by President Joe Biden, while President Trump has met with U.S. Steel's CEO, and we had heard him about weighing in on this deal before, downplaying the need to sell U.S. Steel. So we'll continue to watch what happens with that takeover attempt. We have more ahead on the Asia Trade. This is Bloomberg.
We did. I did an away game over at the Fed. We had a very nice breakfast. Chair Powell and I don't know each other well, so it was very constructive. Everything I'm going to talk about is things Fed done in the past. Prospectively, monetary policy I will not comment on, and I'm sure he's going to do the right thing, so there'll be no criticism.
US Treasury Secretary Scott Bessent there telling Bloomberg about his meeting with Fed Chair Jay Powell. So really kind of talking down some of the more critical rhetoric that we've seen from President Trump, at least in that campaign. But take a look at how US assets are trading the futures session. We're seeing a muted downside there when it comes to stock futures, and steady trading when it comes to Treasury futures. Investors awaiting that key US jobs data to take a look at prospects for what the Fed might do next. But certainly Scott Bessent also calming the markets by leaving the strong US dollar and debt issuance plans intact as well. Bessent says he also personally vetted the Treasury employees when it comes to Elon Musk's government efficiency team, which have read-only access to federal payment data. He spoke to Bloomberg about the concerns that that access had been given to Musk's various business interests.
These are Treasury employees. It is 2 Treasury employees, one of whom I personally interviewed in his final round. There is no tinkering with the system. They are on read-only. They are looking, they can make no changes. It is an operational program to suggest improvement. So we make 1.3 billion payments a year, and this is 2 employees who are working with a group of long-standing employees.
The letter that the Treasury Department sent earlier this week talked about how the team currently does not have access to change the system. Have they at any point this year had the ability to make changes?
Absolutely not. This is no different than you would have at a private company. And by the way, the ability to change the system sits over at the Federal Reserve. So it doesn't even lie in this building. So they could make suggestions on how to change the system, but we don't even run the system.
And if they ask for, if they request the ability to change the system, would you grant that?
No, again, they have no ability to change the system. I have no ability to grant that change. That they can make suggestions, then it would go to the Federal Reserve, and just like any large ERP system, there would be tests, there would be this, there would be that, and then the Fed will determine whether these changes are robust or not.
As the Secretary of Treasury, you also oversee the IRS. Do you know what kind of access the team has to IRS data or individual taxpayer data?
Well, I'm glad you asked that too, because look, the IRS, the privacy issue is one of the biggest issues. And over the past 4 years, we've seen a lot of leaks out of there. The IRS systems are quite poor. When I started in college in 1980, I learned the program in COBOL. I think there are 12 different systems at the IRS that still run on COBOL. But as of now, there is no engagement at the IRS.
And if they request that access, would you sign off on that request?
They haven't, so we'll take that when it comes to it. I think there is a lot to do there, but the president was elected with a big agenda, and to the extent that getting the IRS in better shape is part of that, sure. Because look, with the IRS, what am I concerned about? I am concerned about collections, I'm concerned about privacy, and I'm concerned that the system is robust, and customer service.
But do you think that if they ask for access, that is something you would consider signing off on?
There are a lot of things I would consider, but look, we're in the middle of the tax filing season right now. We even, with the government buyouts that expire at midnight tonight, we have mandated that the IRS customer-facing employees, that they're not eligible for that until May 15th. So I don't imagine anything's going to go on at the IRS until then or beyond.
Elon Musk, just half an hour ago, tweeted out that Treasury needs to stop approving certain payments. Has your staff tried to block any payments here at Treasury?
We have not, and I'm glad you asked that too. And just to put it in perspective, Elon and I are completely aligned in terms of cutting waste and increasing accountability and transparency for the American people. I believe that this DOGE program in my adult life is one of the most important audits of government or changes to government structure we have seen. That when I was in my 20s, we had the Grace Report, and there's some great suggestions that came out of that, never implemented. Under Clinton and Gore, I think it was to government efficiency or reduce government. Nothing happened. So President Trump came in, there's a big agenda, and I think that there are gigantic cost savings for the American people here. And I think it's unfortunate the way the media wants to lampoon what is going on.
Treasury Secretary Scott Bessent speaking with Bloomberg's Sally Hamilton. We should note that since that interview was recorded, a federal judge temporarily delayed the deadline for the administration's buyout program. We have more ahead on the Asia trade. This is Bloomberg.
There are those of us who voted for the cut, some of whom put emphasis on uncertainty and the word careful, some of whom wanted it to be a bit more directional and wanted the word cautious instead of careful, but we chose careful in the end. And then you've got the two members who voted for a larger cut. And if you read the paragraph that comes over, they're probably in different places themselves. So don't put too much weight on the voting.
BOE Governor Andrew Bailey there speaking to us after that 25 basis point rate cut backed by 7 members of the MPC. 2 wanted an even larger half-point cut there. We saw just the massive rally that we saw across stocks hitting a record in Europe overnight. It was a pretty significant rally all round. Really the optimism when it comes to corporate earnings, rising trade uncertainties with the US, and in particular, Shery, we had the likes of Maersk there really driving some of that optimism.
Yeah, we continue to watch central banks. Bank of Korea Governor Rhee Chang-yong is pushing back against mounting speculation of a rate cut later this month. He told us exclusively the further fiscal stimulus is needed to support the economy rather than relying only on monetary policy.
For the time being, I think the government is trying to find a way to expedite their expenditures. And Korea is very good at those fronts, because we have a more electronic system that we can rely on government expenditures, and we are very accustomed to have this kind of swift fiscal support for various business cycle management. So as you mentioned, the problem is that if you use a fiscal stimulus much, that year is good, but on the other hand, the next year's growth prospect will be reduced unless you keep on increasing the fiscal stimulus. In case Korea, I think the government is very know this fact very well. So probably I hope and that they will do some modest fiscal stimulus without hurting the fiscal sustainability.
But because we didn't see that fiscal action coming fast enough, we thought that in the previous rate decision that you would actually cut rates, but you actually held. Yeah. Doesn't the Bank of Korea need to step up efforts right now?
We are definitely also interest rate reduction cycle. So when and how much, we will look at all other elements. But definitely we think that monetary policy and fiscal policy both have a room to have a more accommodative accommodative policies.
Especially now that you have seen a few weeks of the Trump presidency and all of these tariff threats coming into place.
Right. So that is why I'm emphasizing more fiscal stimulus is necessary. First of all, we in the last 2 years, when we have a very high inflation period, unlike other countries' government, our Ministry of Finance maintained a very conservative fiscal policy. So in some sense, we have more fiscal resources when the economy is now heading below the potential growth rate. So we have room. And second, monetary policy has a room to cut because our current interest rate is a slightly higher in a restrictive area. But on the other hand, as you mentioned, given U.S. policies and U.S. Fed policies, the depreciation pressure is building up. So in monetary policy, we have to consider both the stimulus effect as well as its impact on other exchange and other areas too. So that is why I think a policy coordination between fiscal and monetary policy is very necessary at this moment.
We heard all of your board members were in line with being open to a rate cut in the next 3 months.
That doesn't necessarily, this is also called forward guidance, but that is also conditional. So yes, in January, all of our members say that given that we hold the interest rate at the time, given by looking at the economic conditions, there is a good chance that we will cut the rate in our next 3 months period meetings. But that's not the kind of agreement. They will definitely look at the new evidence, and based on the new evidence, they can change their mind. But at this moment, that is the nature of the monetary policy.
Why not make a move now when potentially the effects and fallout of all of these different risks from the domestic and external factors could come in at some point later in the year?
Actually, I think this is a criticism that I got a lot in domestically these days. Why you are not cutting interest rate more actively? I think there are many reasons. I think monetary policy and interest rate cannot solve every problem, okay? And then, like if you have a low interest rate, and definitely it will help people to pay back their debt, and it may make a little more stimulus to the economy. But on the other hand, you have to think about negative side impact. One is that it may end up increasing the asset prices, especially real estate prices. It has a direct impact on the exchange rate. And yes, we can manage it, but if it really depends, environment. If the exchange rate is depreciating quite rapidly, you don't want to put the oil in the fire, right?
Bank of Korea Governor Rhee Chang-yong there speaking to me exclusively on Bloomberg. We have more ahead on the Asia trade. This is Bloomberg. Japanese Prime Minister Shigeru Ishiba will meet President Trump on Friday in Washington. As he left Tokyo, Ishiba told reporters he wants to build a relationship of trust and confirm cooperation over economic and security issues. During last year's election campaign, Trump told Bloomberg he had concerns about Japan's trade surplus with the U.S. and the weakness of the Japanese yen. Let's get more perspective from our next guest, who has built a distinguished career in Japanese diplomatic circles. Tomoyuki Yoshida is Chief Executive Director at the Japan Institute of International Affairs. Great to have you in the Tokyo studio on a day like today, because we're very much anticipating that summit. But at the same time, I wonder if the expectations are a little bit high given Trump's good relationship with former Prime Minister Abe.
Yeah, pleasure to meet you, and thank you very much for inviting me. But the U.S.-Japan relation is, there is not the outstanding issues, but the alliance of the United States is very most important for Japan, and this position is unchanging. It is also true to the United States, the most trusted partner in the Pacific for the United States. But for the American first Trump administration, the alliance alone is not the privilege. It should not be taken for granted. So the relationship should be understood and judged.
I mean, that's what it should be, but the way that the Trump administration has acted in the last 3 weeks against partners like Mexico, very strong allies like Canada, is it a good sign that President Trump at least is not saying anything much about Japan since taking office?
Well, I think that Japan is not in the high radar of the Trump administration, but there are many other issues that the leaders have to talk about. But the important thing is that Japan should be regarded as a trusted partner for the Trump administration in the context of the American first policies. And if it is beneficial for the interest of the United States, the two leaders will cooperate each other. So the first encounter face-to-face by the leaders, the Ishiba should convince Trump Japan is beneficial for United States, as well as Ishiba can work together with
And
Trump.
that will be, I guess, through more investments into the U.S., business relationships?
Well, in the various fields. First of all, the investment. Japan is the largest investor in the United States, creating 1 million jobs there. At the same time, trade surplus of the Japan reduced from the previous Trump 1.0 administration. And maybe Japan can purchase more from the United States, particularly the energy sectors.
As you say, there's no current serious outstanding issues or tension between these long-standing allies. Do you worry about the lack of predictability when it comes to a Trump administration and its policies?
Oh, Well, of course, the unpredictability is the characteristics of the Trump administration under President Trump. But at the same time, unpredictability is one of the predictability. And the Ishiba is well prepared for that. A lot of hearing from those who met with President Trump, as well as the advice from the bureaucrat. So it is not so much concern about the encounter.
It's interesting in the report you talk about the rise of myriad factors from the likes of domestic US political tone to global geopolitical and sort of military shifts, as well as there's a broader rise of populism, right? How much does that sort of contribute to a deterioration broadly when it comes to global governance, and how much confidence do you think there still is in multilateral frameworks like the G7?
Well, the United States is growingly reluctant to engage in settlement of the global issues. And the American people are in the same trend. So we cannot expect the United States alone can resolve the global issues. Japan should demonstrate the positions to work together and to share the responsibility with the United States.
I'm not sure, though, Tomoyuki, because it's the unpredictability, as you said earlier, right? Because didn't President Trump want to have the U.S. inside Gaza at this point, which is very much not what he's been advocating so far? In that sense, though, the feel, though, it seems to be always the constant, that President Trump wants other countries to pay more for defense, for security alliances. When it comes to Japan-specific issues, hosting American bases here in Japan, will that be a contentious issue with this administration as well, wanting Japan to foot more of that bill?
Under the previous Kishida administration, Japan decided to increase the defense spending up until 2% of the GDP within 5 years by the end of 2027. And it is in the process. And also the mindset of the Japanese people about our defense is quite different from the previous years. Maybe it is not sufficient for Trump administration. That Trump will require more spending, but it is not the things that we are urged to do. But given the very serious, severe international environment surrounding Japan, Japan has to do efforts, the building the defense by their own sake.
Remember the first term of the Trump administration when we had this very surprising summits with North Korea's Kim Jong-un? How of an awkward position is that for allies like Japan?
Well, the denuclearization of the North Korea is
which really has not gone anywhere.
No. So we have to anticipate that the next deal, if it happens, still this is not the priority for the President Trump. The President of Trump may be first pressure the North Korea to refrain from assisting with Russia in Ukraine. But maybe later they are going to be the deal. So we need to consult with each other with the United States what we should anticipate and what Japan can do for the negotiation with the DPRK.
Tomoyuki Yoshida from the Japan Institute of International Affairs. It was really good to have you with us. Thank you so much for your insights and, of course, all of this as we continue to watch the Japanese yen as well, which could be a point of contention as well for the Trump administration. We're still watching that. He has mentioned in the past the weakness of the yen as a problem. Of course, we have an enormous trade surplus of Japan against the U.S. And you're seeing right now a little bit of strength against the greenback. Of course, we have heard from the BOJ board member Tamura as well about sending the rate to 1% by March of next year, the tightening moves helping that, and perhaps a little bit of safe haven moves as well, Haidi.
Well, Shery, US Treasury Secretary Scott Bessent has defended President Trump's new tariffs on China, saying they're only designed to ensure fair trade. Bessent dismissed concerns that the levies will be inflationary for the US, telling Bloomberg that China will pay the higher price.
China is the most imbalanced unbalanced economy in the history of the world, and they are in a deep recession right now. They're experiencing deflation, and they're trying to export their way out of that. And we can't allow that. We want fair trade, and part of that is taking a strong position on the currency and the terms of trade.
But what about the inflation concerns that are stemming from the tariffs and tariff threats?
Look, I'm not sure that where this narrative that tariffs for the country putting on the tariffs is inflationary, that we could have a small one-time price adjustment, that as we saw in Trump 1.0, that the deregulation and the other policies, we stayed right around the Fed's target level. So I'm unconcerned about that. I think especially that China now, given all their excess capacity, will, no matter the level of the tariffs, will end up eating quite a bit.
There's a lot of uncertainty around tariffs. We see them threatened or signaled, and then they're taken back. It appears as if this administration might be unfriendly to businesses. Is that right?
Really? I think it's just the opposite. I think this is the most pro-business administration in history. And everything we are doing is going to increase the after-tax return on capital. And as a result, working Americans will have very high real wage growth. That what we've seen over the past 4 years is the government and government-adjacent sectors providing the employment growth. And why have we experienced this affordability crisis? First, there was a massive spending met by increased regulation, which caused inflation. And then government and government-adjacent jobs do not cause real wage growth because they move up at CPI. So, I think that we are going to not only be business friendly, but very, very friendly for working Americans.
U.S. Treasury Secretary Scott Bessent speaking to Bloomberg's Saleh Hamosin. Bessent also talking about the strong dollar policy continuing under the Trump administration. We have seen dollar strength, of course, recently. A little bit of weakness in today's session, reversing some of those earlier gains ahead of what could be a messy jobs data factoring in the California wildfires. On that other side of the trade, we are seeing a little bit of upside for emerging market currencies. Latin American currencies extending their outperformance within the basket. Of course, we have seen a little bit of quiet and calm return to, say, the Mexican peso, given that those tariffs have been delayed by a month. We have more ahead on the Asia trade. This is Bloomberg.
Some of the corporate stories that we're following this hour, and Chinese retailers on Shein and Temu are feeling the pain of tariffs. Logistics agents have asked them to pay an additional 30% levy on goods imported to the US from China and Hong Kong. According to a memo seen by Bloomberg, retailers have been asked to pay the extra as a deposit. Agents will then adjust the final amount depending on the actual tax charges from US Customs. Meanwhile, Hong Kong Post has announced that it won't be accepting parcels to the US until further notice. According to a government statement, the decision was due to matters that need further clarification with the US Postal Service. It is just the latest turn in a messy saga after the USPS halted inbound packages from China and Hong Kong this week before reversing that decision. It's really just one example of how Hong Kong is getting swept up in Trump's trade war with China. The city also being hit with punitive measures after losing exemptions. For more, let's bring our China correspondent, Milne. So it's the messiness, right? And the messiness and the sort of unknown elements of risks that Hong Kong is now facing when it comes to trade and tariffs. What do we know?
That's right, Heidi. The line is really blurring between Hong Kong and China, especially after President Trump, in his first term in power in 2020, he signed that executive order to end preferential treatment for Hong Kong when it comes to economic and trade matters. That was after Beijing imposed that national security law in Hong Kong. That means that these tariffs on Chinese goods, 10% tariffs, for the first time, they also apply to Hong Kong goods as well. And you mentioned earlier the U.S. Postal Service flip-flopping on its policy about whether to accept accept parcels from Hong Kong alongside those from China. And across the world, you have the Panama government also mulling cancelling the contract of a Hong Kong conglomerate, Hutchison, which operates 2 of the 5 ports in the Panama Canal. This is after threats from President Trump, who is falsely accusing China of running that canal. So all of these risks adding together really threatens to pummel Hong Kong's reputation as that stable business hub and its role as that international connector between mainland China and the rest of the world. That's also under question as these policy differences between mainland China and offshore here in Hong Kong is being eroded as well. And this, by the way, also comes after the strict COVID restrictions and the national security law, the jailing of these pro-democracy activists that had already led to this exodus of talent, of expats from Hong Kong over the past few years.
Yeah, I mean, I remember the first term of the Trump presidency, we had these questions about Hong Kong as a financial hub, given all of these concerns. And then we had the COVID lockdowns. Then we had the property slump. I mean, things are not getting great for Hong Kong. So what do we know about the potential impact specifically coming from potential tariffs?
So for now, economists think that those tariffs are not going to have a huge impact because they mainly apply on goods that are manufactured in the city. And that applies to only 1.3% of Hong Kong's exports to the U.S., things like metals, gold, jewelry, because the bulk of Hong Kong's exports, fortunately, consists of re-exports from other countries because Hong Kong is, in some ways, a very big transshipment hub. But still, for many of the businesses based here in Hong Kong, they now have to contend with these sort of geopolitical risks that for a long time the city has been shielded from. And taking Hutchison as an example, some companies may now be more reluctant to invest overseas, especially in strategic sectors that could come under fire from the U.S., for example. And that's why Chinese Hong Kong officials have been trying to encourage businesses here to diversify into regions like the Middle East, for example, where China has close ties with. They're even encouraging cab drivers to learn Arabic so that they can welcome tourists and visitors from the Middle East, for example. And this comes as the Hong Kong government also issued a statement you see on the screen there, emphasizing that this is a separate customs territory and condemning those tariffs, calling on the U.S. to really correct and rectify its mistakes.
And Bloomberg's China correspondent Min Lo. Right, let's take a look at one Hong Kong e-commerce platform because South Korea's beauty exports topped $10 billion for the first time last year, even outpacing traditional leader France in some major markets. Tech reporter Annabelle Drewler's look at how e-commerce firms are moving to benefit from this rapid change.
Medicube and Beauty of Joseon. They're not exactly household names for some, but for a younger generation of consumers, these upstart K-beauty brands are becoming the #1 choice. It's symbolic of a bigger trend that's taking place in the global cosmetics industry, where Korea's small and medium-sized companies are getting wider recognition and outselling more established and much bigger rivals. That shift has come about even as K-beauty grapples with a slowdown in sales to China, with firms now targeting new markets further afield. Hong Kong-based e-commerce company Yes Asia is one that's riding this K-beauty wave. Through its Yes Style platform, it sells Korean cosmetics into more than 200 territories, with business booming in recent years.
Still, there are risks on the horizon, including the uncertainty over TikTok's fate in the US. It's a favourite platform for beauty influencers, including Yes Style's 300,000-plus network.
UOB also says the group could face margin erosion as it rapidly expands its B2B unit. But for now, Yes Asia says the outlook is bright, signalling record annual profit growth. Annabelle Drewler, Bloomberg News, Hong Kong.
We'll be speaking with the founder and CEO of Yes Asia, Joshua Lau, later on the China Show for more on the booming business of beauty. More ahead on the Asia trade. This is Bloomberg.
Take a look at how Nissan and Honda are trading at the moment. We're seeing some gains for Nissan. We are now hearing that Honda's plan to absorb Nissan is deteriorating because of disagreements over the power imbalance between the two companies, Honda losing about 1%. Another scoop from Bloomberg that Nissan is looking for new partners as this deal is expected to collapse, ideally from the U.S. technology sector, according to people speaking on the matter. Let's get more with our senior editor, Reed Stevenson, on this potential tie-up. And there was a lot of expectations about what this could mean for the auto sector here in Japan. But how did we get here?
Yeah, I mean, essentially, Nissan has been in a situation where they need help. And so we've seen back in December, Nissan and Honda announcing sort of a framework for discussions that they were calling a merger, but it was effectively going to be Honda taking over Nissan under a joint holding company structure. Again, there was no final deal, and in fact, they were aiming for something to be materialized in June of this year and then finalized in June of 2026. But very quickly, right in the new year, we've seen the whole thing kind of collapse. And a lot of it comes down to essentially Honda recognizing that Nissan is the weaker partner here. Nissan and Honda make roughly the same amount of cars, 3 to 4 million units a year, but Honda's market cap is now more than 5 times that of Nissan's, and so it's got more strength at the negotiating table. But of course, Nissan, having been one of the leaders of the Japanese auto industry, is balking at this. They don't want to come under control of Honda. And so we just learned this week that now it looks like they're going to be set to part ways.
What are we expecting from Nissan's results next week?
Well, so next week on the 13th, we're going to get results. The chances are quite high that we're going to see a lot of red ink, and also their board will meet. And what we're hearing is that that's when essentially the calling off of negotiations with Honda is going to be confirmed by the directors.
Are we sort of seeing broad trends across the sector at this point?
Yeah, I mean, the backdrop to this entire saga has been the shift toward electrification and autonomous driving. We've seen automakers everywhere, pouring billions with little to show for it. And of course, consolidation is going to be part of that story. They need to join forces to pull resources to develop these new technologies to compete against upstarts like BYD and Tesla that are really taking the early lead in electrification here.
Bloomberg senior editor Reed Stevenson there with the latest. And take a look at some of the other corporate stories that we're following this hour. Tokyo Electron is sticking by its annual outlook while outlining plans to build a $681 million plant, suggesting it expects sustained AI spending. It is just one of a handful of global chip gear makers and has customers, including Samsung and TSMC. It also reported better than expected quarterly earnings, with operating profit jumping 51% from a year ago. Honeywell shares fell as it confirmed it will split into 2 publicly traded companies following pressure from activist investor Elliott Management. It will separate its aerospace division from its automation business while continuing with earlier plans to spin off its advanced materials unit. Honeywell says the process should be complete by the second half of next year. Taking a look at how we're setting up when it comes to futures trading across Greater China. We're just about half an hour from the start of the cash session there. We are seeing Taiwan futures looking like we could see a little bit of positivity there, but A50 China futures looking pretty muted, 0.4% softer, as broader markets are sort of trading on the sidelines ahead of US jobs numbers, and whether that gives a little bit more indication of where the Fed heads from here. We'll be watching some of those e-commerce and sort of postal related names as well, as we have further developments in Hong Kong, with Hong Kong Post now halting intake of US-bound parcels as well. So still a whole lot of messiness when it comes to how parts of the economy and corporations are being hit by these tit-for-tat tariffs. This is Bloomberg.